everyone, and thank you very much for joining us today for this workshop. My name is Katerina Lysenkova, and I work at NatWest Group as an economist. And today we're going to be talking about the work that was done together by NatWest Group, Vivid Economics, and NIESR, and present some results of the work that we've done. So first things first, some housekeeping. We are recording this section, so we will be able to share the video with you later. We have about an hour for presentation and then 30 minutes for questions and discussion. And we hope that it's going to be as lively as Zoom allows us to have. Also, if you have questions during the presentation, please write them down in the chat function so that you don't forget them, and we will turn to them after the presentation is completed. And I think we are happy, we are all ready to start the presentation. Although I see that some people are still entering. Maybe I'll wait just for 30 seconds to allow everyone to be on the call. Okay, so I first want to start with explaining why we decided to arrange this workshop. This work came as a result of the NatWest Group preparation for the biennial exploratory scenario on climate, which is planned by the PRA for next year. In the absence of the macro-financial scenarios developed by the PRA, we thought that we do our own research, our own analysis in this, and this is how this project was created. So that's why you will see that the scenarios that we were selecting and the approaches we were using is in some sense shaped by the exercise that we are preparing for. And the reason we decided to go public and to share it much wider with you and with other groups as well is because it's a very early days in our understanding of how to model effects of climate change on the economy. And we think that collectively, if we work and share, we're going to get to the final destination much sooner. So that's why we think that collaboration is the way to go in this area. And in particular, scenarios is very easy and safe area for sharing and collaboration because it's a building block on top of which everybody is developing their own analysis. So it's good if those building foundation stones are the same for all the organizations that are working in this area. And that's why we wanted to share whatever we learned. This is by no means is a final answer to these questions. But we wanted to make our small contribution to our collective understanding of how to model climate effects on the macroeconomic parameters. And that's the purpose of this presentation, show you what we did, and presumably we want to focus on how we did it and what questions we were asking ourselves, what sensitivities we were discussing between this group that is going to be presenting. And then get your reaction and potentially discuss future collaborations that we can have and we can form together jointly with you. In addition to this workshop, we're also going to create an Excel spreadsheet with the scenarios that we created, and they're going to be hosted by NIESR. And in the next couple of days, we're going to share the recording of this session together with a link to the scenarios that you can all download and have a look, and we're happy to discuss them in future if you have any questions. So let me start now the slideshow. I know that not all of you are from the financial industry, and I also know that not all of you are from the UK. But because we are finding ourselves in these circumstances, that shaped our thinking about the scenarios necessarily. And that's why all of this, as I said, was the reaction to the biennial exploratory scenario on climate by the PRA, which all the banks in the UK at the moment are preparing. But in general, when I'm thinking about the different scenarios, different climate scenarios that financial industry is going to be using now and in the future, I would put them into three very wide buckets, and those buckets are not exclusive. So there could be an overlap between them, but in principle, I find it easier to think about it in these conceptual terms. So I think that there are some scenarios of what we want to happen. And this is everything that has to do with the principles of responsible banking, principles of responsible investing, science-based targets, Paris alignment targets. So, and there you are targeting, want to modify your behavior, your client's behavior, so that we can achieve the global warming, or keep the global warming well below 2 degrees. Some people are more ambitious and they're aiming for 1.5 degrees Celsius. So this is what we want to happen. And we need scenarios for this, because if you're aiming for something, you need to have a trajectory and a pathway of how you're going to get there. Then there is another bucket, and for some people it will overlap with the first one, for some it won't, and this is what we think will happen. And here there is a big question mark about what temperature is going to happen, is going to materialize, but we need to have this vision for the short and medium term view. This is our base case scenario for any analysis that we do internally for planning and budgeting purposes. And then there is a third bucket, what we need to prepare for. And I highlighted it because this is your stress test, your scenario analysis, and this is where we started. And here you need a wide range of possibilities, because we can see different trajectories ranging from 1.5 degrees Celsius up to 4 degrees Celsius by the end of the century. And this is your long-term view for scenario analysis, for internal and regulatory stress tests. And this is where we started. But despite the fact that you can think about different scenarios that you use for different purposes, underlying all of this, if you want to have some macroeconomic view of how those climate scenarios are going to, what impact they're going to generate, underneath all of this, the links between the climate and economy are the same. So the transmission channels are the same. And even though we are talking today about this kind of right bucket, what we need to prepare for the stress testing, for the BES, for our scenario analysis, the underlying principles we think are the same. And that's why it's important that we understand how we can link climate change, transition to a new low carbon future, and macroeconomic channels. So as I said, because we are preparing for BES, we started with NGFS climate scenarios that were published in July this year, because we know that this is going to be a foundation upon which the PRA is going to develop their scenarios that they're going to share with the banks. So this was our starting block. And then at the end of the day, what we wanted to achieve is to get macroeconomic scenario that is consistent with the NGFS climate scenario. So what does these changes in climate and the transition variables mean for the macroeconomic variables? So we knew where we're starting, and we knew where we want to get. We also knew about the work that the NIESR was doing for several years in the area of incorporating climate into macroeconomic framework, into NIGEM. So we already understood that if we can specify shocks at granular enough level, and also we knew the shape of the shocks that we need to specify, then we can have the scenarios generated by NIGEM, which give you all the usual macroeconomic variables. But there was a missing link, because NGFS scenarios are not detailed enough. They're quite high level. They're aggregated at the large regional groups, and NIGEM needs shocks at the country level. So we needed somehow to bridge this gap between the granularity of NGFS scenarios and the NIGEM. And the missing link there was the Vivid Economics, which helped us to generate those granular climate shocks. And today, each of the parties that took part in this project are going to present their side of the project. Just very briefly, I'm pretty sure that most of you know what about the NGFS scenarios and what they are, but in case someone is not familiar. NGFS is a network for green and financial system, is the group of the central banks and regulators that is championing the incorporation of climate risk in the financial industry. And they created this framework about how to specify your scenarios, how to think about scenarios. And the chart on the right, schematic on the right, is showing you how they're thinking about it. And they classify all the scenarios according to two criteria. The first one, whether transition is happening or not. Do we transition to the new low carbon world that we want to achieve or not? And then also whether it's happening orderly or disorderly. And using these two criteria, you can generate like 4 different quadrants and 4 different scenarios. For the first iteration of the scenarios that they released, they only concentrated on the 3. They created orderly transition scenario, disorderly transition scenario, and hothouse world, the scenario in which we do not transition, and we have very high physical risk, but at the same time low transition risks. In the orderly scenario, this is basically what we all try to achieve. We want to keep the temperature below 2 degrees. And we also want to get the transition as smooth as possible. For this, to achieve this goal, what you need is to introduce climate mitigation policy early and steadily increase them. And in this case, you will get the orderly transition. Disorderly transition, still the same. We want to limit the temperature by the end of the century to below 2 degrees, but at the same time, the transition is delayed until 2030, and then also technology is not available. This CDR is carbon dioxide removal technology is not widely available. That's why you need to kind of slam your brakes much harder after 2030 to be able to still keep the temperature below 2 degrees. And then in the hothouse world, we continue with the current policies. And national determined contributions are not met, and emissions keep growing until 2080. And this leads us to the about 3-degree warming by the end of the century. So within this framework, NGFS published a number of scenarios for each of the categories: orderly, disorderly, and hothouse world. The scenarios that we picked are the representative market scenarios, and today's work, we're going to be talking about them. And this is just a summary of how the key climate variables look like in each of the scenarios. It all starts with the carbon price, because carbon price is the only mechanism within the scenarios in terms of the policy that can limit the climate change. And in the hothouse world, there is virtually no carbon taxes. They're still at the same level, slightly above the level that we had in 2020. And what it means is that emissions keep growing because we are not trying to limit them. In orderly scenario, the carbon price increased steadily, gradually, but steadily. In disorderly, you can see that because we take no action until 2030, the speed at which the taxes are being introduced is very steep indeed. I would say that CO2 emissions looks almost like a mirror image to the carbon price. The higher the price, the lower the emissions. So in the hothouse world, a steady, slow increase in emissions. In orderly scenario, emissions are declining immediately and steadily. And in disorderly, again, we're waiting until 2030, and then the speed at which the emissions need to decrease is much faster.
Could I ask a question? Sorry, I have a question about this, because I've working with climate scenarios for some time now, and I understood that according to scientists, there is no trade-off between emissions and warming in the next 20 to 30 years, and I see the graphs go to 2050. So what I understood is that the warming pathway in a 4-degree world, or in a 2-degree world, or maybe even 1.5, for the next 20 to 30 years is very similar, very close to one another, because it's locked in. And what we're doing now about reducing emissions only will have impact in 20 to 30 years. So I'm not sure if that is visible.
Yeah, and you will see this, you will see it on the chart on the right hand side. So here we have, instead of 3 lines, we have, I added 4 lines. So, and I'll explain why now. So the pink line is still orderly scenario, the green one is a disorderly, and you can see that the difference in temperature is really small. And I would say that the temperature in the next few years is probably driven by the fact that NGFS are using different models more than by the fact that the scenarios between orderly and disorderly are different. And the hothouse world is the one from NGFS is this very faint dotted blue line. So this is what the NGFS are created. So over the next 50 years, you will see that the difference between the 3 scenarios is minimal. And you correctly said the reason for it is because there is a lot of inertia in this process, and a lot of temperature change already locked in. The reason we have the dark blue line there is because when the PRA was discussing biannual exploratory scenario, what they said is that they want to fast forward physical impact, and whatever is projected to happen by 2080, they want to fast forward those impacts by 2050. And this is what we do here. Basically, we're just saying that the temperature change is much quicker than what the NGFS scenarios predict, and 2080 temperature already happens in 2050. I think the reason why PRA wants to do this is because there is a lot of uncertainty about how what global mean temperature you're going to get given the level of emissions. The link between emissions and the temperature is quite uncertain, and there is a wide margin of distribution around those numbers, and that's why they wanted to account for some of this uncertainty, and they brought it forward. And we did the same. So for the scenarios we're talking today, we're talking about fast forward hothouse world, the way the PRA is planning to do it. And now I want to give you just some flavor of the results and why things are happening the way they're happening. We're going to discuss in the next sessions. But now I just want to show you the high level of where we got, what we got out of this very brief and very quick project. The first thing, here I'm showing you just some key variables for the UK, because UK was the focus of our work. And please, if you're not speaking, can you please mute yourself, because we hear some echo. One thing that you will notice here is that we have 2 transition, the colors are still the same. So transition scenarios are pink and green, orderly and disorderly, and hothouse world is blue. One thing you will notice right away is that the hothouse world scenario is less, has less negative impacts than the transition scenarios. And we need to, and we're going to discuss it to some extent in the future. You need to understand which bits of the these physical impacts we were able to incorporate in those scenarios and which we weren't. But the way the physical impacts are specified here in this work, we are not getting a very strong impact by 2050 within the UK, and this is actually true across the world. I'll show you in a minute. Another thing, high-level conclusion that we reached is, of course, orderly transition is strongly preferable to disorderly transition. But this is quite intuitive. And another good thing, which is, well, good thing from my point of view, is that orderly transition is affordable. It's affordable in the UK, it's affordable in other countries. Yes, by 2050, we have a GDP which is lower than in the baseline by about 1.5, maybe 2%, depending on which country you're looking at. But if it allows us to maintain this world and preserve the planet in a better state than otherwise, I think this is the price that we can collectively agree that we can pay. And another interesting thing to keep in mind is that climate shocks, they're multidimensional. So a lot of things are happening, and we're in the future sections, we're going to discuss those channels. And those different channels, how climate is affecting the economy, are pushing variables in different directions. So this multidimensional impact, we need to keep in mind. It's not a simple story between higher taxes, higher prices, and what's happening there. So this is the UK picture, and this is just some selected countries. And the story is still the same. Hothouse world is not as has such a negative impact. Orderly is preferable to disorderly, and yeah. So here some other countries are showing you that the high level conclusions are maintained throughout the scenario. And now, as I said, we need to keep in mind which channels we are introducing in those in this work, and which things we were not able yet, and maybe we'll be working on in future. So these scenarios combine both transition and physical impact, and this is the beauty of the NIGEM framework, that it can incorporate both physical and transition shocks in it. In terms of the transition, the shocks that we looked at, we introduced carbon taxes, we introduced energy demand by fuel by country, we introduced energy prices by fuel and by country, and then with respect to stranded assets, we did this analysis elsewhere, not within the NIGEM, and in general, all of our asset price analysis that we did it separately. So here we're not going to be presenting that. In terms of the physical impacts, what we're taking into account, we take annual average damages from flooding, which is your one type of your acute shocks. We also take into account agriculture and labor productivity, which are your examples of the chronic shocks. We assume that there is an adaptation. Cost-effective adaptation measures are being introduced. So if, for example, it's effective to build a flood defenses, we assume that they're going to be built. And now to the things which we are not taking into account here. We're not taking into account other perils, wildfires, freeze, tropical cyclones. The reason for it was because we had a very limited time to do this work, but other reasons is because we were concentrating on the UK economy, and the floods are the biggest shock that we're expecting from the higher temperatures in the UK. So obviously this is something that for other countries you would pay much more attention to. And potentially a strong influence on the economy. And then there is another strand which I haven't seen anyone discussing yet, only on the kind of philosophical level, but not in the level of the concrete analysis. There is a strong indication that the climate change is going to have a very serious socioeconomic impact. Conflicts, mass migration, effects on the human health. So this we are not taking into account. And obviously this is very important. And we're not saying that we didn't include it because it's not important. We just said, this is what we managed to incorporate. And then there is a long list of things that are still there to discuss in the future. And now I'm going to hand over to Thomas from Vivid Economics, who is going to tell you about how we generated those shocks at the country level. And he will be able to describe it to you. Thomas, to you.
Perfect. Thanks for the introduction, Katrina. So yes, my name is Thomas. I'm from Vivid Economics. I was leading this project on the REST group on the Vivid side. The specific items I'm going to talk through with you today is really around how do you bridge that gap from going from the network from the NGFS scenarios, which are very aggregate, to the inputs to the NIGEM model, which are more disaggregate. And those are basically the items that we're talking through here in the blue table. There are both physical and transition variables we need to translate from the NGFS scenarios to a more granular level. I will go through each of those in detail, but just to touch on them, from the NGFS scenarios, we get a temperature profile as Katarina has outlined. But from that temperature profile, we need to understand what does that mean for local temperatures in different countries, and also what does those local temperatures mean for the chronic impacts, both in terms of labor productivity and land productivity. The same thing on the acute side of things. We get from the NGFS scenarios, temperature profiles. We need to understand what does that mean for the frequency and the average annual damages from flood events. That's what we have looked at here because of the focus of the UK, both coastal and river flooding events. And then on the transition side, we get from the NGFS scenarios regional energy demand patterns on the different scenarios. So, for example, how much does North America demand in terms of oil and gas? But we do not get them at a country level. We need to be capable of estimating them at a country level. So we need to take those aggregate trends that come out of the energy system models and downscale them to a country level on the energy demand side of things. And then we need a series of prices, because what happens to the cost of both carbon that comes directly from the NGFS scenarios, but what happens to the prices of the key commodities, so oil price, gas price, coal prices, we need to clear the market. So the NGFS scenarios are very good at forecasting the quantities, but less strong on the price implications. So we need to model the prices of these commodities through time. And then there's a small piece which we will not cover today, which is around the equity index changes. So we do that bottom up, and I don't think we should cover that today, but that's an element as well. For the Bank of England request. Now, all of these outputs, just 1 second, all of these outputs that we deliver are then translated into, you can think about it as a big data file, and that data file is of course shared with NIGEM, which then slots in like a Lego piece and fits into the macroeconomic modeling exercise, which we'll be discussing in the next section by our colleague NIESR. Now, if we could go to the next one, let's start looking at the first part of it, which is around how do we take the global primary energy trends or the regional primary energy trends and translate them down to individual country level. And the way we do that is we know something around where are the country's energy mix today. So, for example, what is the energy mix of the UK? And we know what the regional energy mix is. And then we model them as converging towards those levels of regional levels that we have in the NGFS scenario. So let's say that you are Germany, you have a certain proportion of coal in your mix today. The region of Western Europe, which you will be in, has another proportion of coal by 2050. You converge towards that. And then where we see the changes in energy demand over time by country, by source. Now, what that looks like in practice, I think it's useful to look at that. If we turn to the next slide. Basically energy outlooks as implied by the NGFS scenarios for individual countries and for every single scenario, because for every single scenario we have a different energy system. If we take the two top ones, the orderly and disorderly, these are what we would call transition scenarios. So they are scenarios of quite aggressive carbon pricing, as Katarina laid out, and the orderly is one where carbon pricing kicks in instantly. And that means, of course, that there is a rapid phase out of the most emissions intensive fuels. So not surprisingly, coal is phased out very quickly. Then oil is, of course, also phased out, but a little bit more gradually. Gas might be phased out a bit, but maybe plateau. And at the expense of that, you see significant uptake in renewables, especially renewables, solar and wind renewables. And that happens across the globe, but it happens, of course, to varying degrees across different countries, depending on how is their economic composition and what is their starting point. The disorderly, if we look at that in comparison to the orderly scenario, the disorderly scenario is a scenario where policymakers do nothing until 2030, and then they wake up and they really need to ramp on the brakes to make sure that we don't end up in a climate disaster. And that means, of course, that you can have a growing profile for some emissions-intensive fuels up to 2030 and then falling off. You see that in the India case here at the end, where you see actually a little bit of growth in coal demand, and then, of course, you really shut it off. These disruptive patterns have implications for equity, but you also see that it will have implications for the macro results later on. Now, finally, I would like to point your attention to the hothouse scenario. The hothouse scenario is, as mentioned, a scenario where not an awful lot change, meaning policy remains as it is. And as a consequence, emissions change. And you can really see why emissions change here in this chart, or these charts here. That's because you see increases in almost all energy vectors and emissions intensive. You also see uptake in renewables, but not to the scale you see in the transition scenarios. And some of you might wonder, why do you see upscale in transition in renewables if there's no policy? That's because there's inbuilt in these scenarios are technological change. So renewables do also become cheaper over time, and therefore you do have some renewable deployment, additional renewable deployment, even without any policy being applied. And that's very much in line with what we actually see in markets today. Okay. Now, if we turn to the next slide, exactly. We want to know what are the price implications of these demand contractions we see on the previous slide. So what does it actually mean for oil prices, gas prices, coal prices, that you see a very significant risk contraction in quantities demanded relative to the baseline outlook? And that we model in the way that is illustrated here to the left. Basically, we build bottom up the global supply curve for each of these fuels. So what is the break-even curve cost of different wells through time, all the way out to 2050. And that gives you a nice supply curve. And by applying the contractions in demand that we have from the NGFS, we can understand what are the price implications. So we can basically pull out the series you see here to the right. This is only an indicative example I have here on the right, but will show you what the actual results are. And those contractions we can apply relative to current commodity prices. Okay, now what if we just say, now what you as a smart observer here would see is, of course, the contraction in prices as a result of quantity depends very much on the functional form of the supply curve. So how steep or flat is the supply curve? And basically, what is the variation in break-even costs across the industry? And what you see in oil and gas markets is generally they have a very, very steep oil supply curve, meaning that even small contractions in demand can lead to very, very big price falls. And that is important for both the inputs we give to NIGEM, but also the way that investors should look at this. Investors and banks should look at these risks materializing, that even though you only see small quantity falls, you can see very big price falls. Now, let's look at what those results look like in reality when we go to the next slide. Thank you very much. And here you can see the changes in prices relative to current levels. So we have normalized everything to current levels today. This is slightly outdated now. I think the oil price has changed a bit since we did this analysis, but it gives a good indication. And what you can see here is that coal prices, not surprisingly, fall very rapidly in the beginning. And that's because you see, independent of what scenario we're looking at, you see a very big contraction in both orderly and disorderly scenarios. And you actually see it even before the policy, and that's because there's a slight mismatch in the NGFS models here, in that you see coal phase out already earlier, also in the disorderly scenario. Oil happens a little bit later, and there's not that big a difference between disorderly and orderly because the electrification of transport happens later in the period. But very interestingly, for gas, there is quite a significant difference between what happens in orderly and disorderly scenarios. In the orderly scenarios, you see actually an uptake in gas demand in the short run, and then a rapid decrease in gas demand, and hence prices falling in 2030. And these patterns are really driven by what is built into the NGFS. Now, alongside all of this sits, of course, the carbon price shock, which is applied across industries, so independent of whether you are a supplier of energy or a consumer. Now, if we go to the next one, we have talked about transition shocks here, both what happens to the energy system as a result of carbon prices. Not surprisingly, demand less oil and gas, more renewables. We've talked about what it means for prices. Now, I'd like to talk to you about how do we then model the physical impacts. The physical impacts are driven by the temperature change, which comes out of the NGFS. And we need the ability to translate temperature changes into chronic contractions in productivity for labor and agriculture. And those we feed through a CDE model, ETAP CDE model, to understand what does that mean on a local level. That, of course, depends on the economic composition of those economies and the magnitude of the shock. And I think it was mentioned by Alexandra that the temporal profile of these temperature shocks is so that they come later in the period. So even with the Bank of England assumption of fast forwarding physical risks to 2080 impacts to 2050, you see these materializing more towards the end of the period, whereas you see the transition shocks materializing early in the period. Now that gives us contractions in output by sector by country later in the period. Now, finally, we need to model what we would call the acute impacts or the average annual damages. So what happens with higher temperatures is that more extreme weather events such as coastal and river flooding occur more often. And that is linked directly to the temperature profile. Higher temperatures, more frequency, hence more severity, hence more impact. And the way we model that is we model the hazards exposure and vulnerability to get to the average annual damages on a country level, and those are the results. Now, if we look at the next slide, I think I will, Dawn, I will return to your questions just towards the end of the session, if that's okay. Now, if we look at the physical shocks, we see that the physical shocks vary considerably across countries. And we were focused on the UK, and the UK is in a bit of a special position in that physical shocks are maybe not as big as for other parts of the world because the location of the UK. But there are countries that are really badly affected by physical shocks. We pulled out 3 examples here: India, Indonesia, Vietnam, and Singapore, which were not the core focus of the study as we set it out, but for whom physical impacts are way higher than they are for the UK and for most developed economies. And that's a question of 2 things: the sector composition of those economies, the location of those economies. So are you in a more exposed region, and are you in sectors that are more exposed? Then you are at risk, of course. So when we look at the results that we have done here, which are focused more on developed economies and especially the UK, you might have a bit of a blind spot towards some of those developing markets for whom impacts are bigger than what we find here. Okay. I will maybe say one thing more on physical just before we go on. A key sensitivity that we are currently exploring, and which you might want to explore, is around the level of adaptation that is happening. So one can assume that countries do adapt to changing temperatures. So you change your agricultural practices or your working practices with higher temperatures, or you put in flood defenses to avoid more extreme weather events. The more of these adaptation you assume, of course, the smaller the impacts on the wider economy is. But adaptation is, of course, a sensitivity, because we don't know if the degree to which these adaptive measures are taken off. So right now we are looking into scenarios which are less applying less adaptation than what we have done in the first exercise. Perfect. I think I will hand over to my colleagues at NIESR, just because
Thomas,
this is, yes?
Sorry, this is Nicola Markussen from Société Générale. Can I just ask you a quick question? In your considerations, did you think about how individual countries could be exposed to global supply chains? Because I understand the point that you could have, like, the UK would be maybe not that exposed to climate risk per se, but if the economy was very dependent on supplies coming from countries that in turn are very exposed, is this something that you brought into your model?
Yeah, so I think some of it will be captured around the trade relationships in the work that NIESR then does with our shocks. So we, in a way, look at what are the shocks at a country level from the first kind of just the impact of the changing conditions, and not the way this might feed through to trade, etc. So I think maybe it's better covered in the NIESR section, if that's okay.
Okay, thank you, Thomas.
And I think there was another question which I'm happy to cover it in the end, but there was a question from Dawn, I believe, around the oil prices being fairly flat, and then rises sharply after about 20. So just in terms of what I just showed you there, we're looking at changes in prices relative to current levels. So everything is here normalized to current levels. It is correct that, of course, real oil prices, there's sort of volatility, but we're looking at what are the changes in demand relative to a baseline, and then we assume that prices would be constant at current baseline. So that's why they're really, the baseline is flat always. We're always looking at changes from a flat baseline. I think I will hand over to my colleagues at NIESR now, if that's okay.
Well, thank you very much, Thomas. And I'd like to actually start by thanking our collaborators at both NatWest Group and Vivid for actually making this project both interesting and able to be completed. All of us brought something to the table, and I think that sort of collaboration needs to be acknowledged and actually improved on if possible. So, quick overview of what NIGEM is for those of you who actually never heard of us before, or only have a passing knowledge of us. We've a global econometric model based at NIESR. It's been used for over 30 years, mainly in the policymaker sector, but its main things are it consists of country models for the major economies linked through goods, services, and integrated capital markets. We have models for all of the OECD countries apart
Ian, sorry, we are having trouble with your connection, I think.
Will be being added.
Ian, can you hear me?
Jana, would you be able to take over from Ian?
Before him, yes, probably that's what I'll do. Give me a sec.
Thank you.
Okay, so before Ian rejoins us, and hopefully he will be able to switch to other internet provider with a better connection, I will pick up where he left. So in terms of the NIGEM, so as Ian said, we have models for almost all OECD economies, with Iceland will be adding in January, so it will be only Israel that is missing, and plus country models, the large country models which are non-OECD are modeled separately. And for those economies that we do not have separate models, they are grouped to the regional blocks, so we are covering the rest of the world. So basically world GDP is summed up. In terms of the individual country model, so what are the features? So we have the sticky prices. We can have forward-looking expectations as well as the backward-looking. So we can have forward-looking consumers and investment. We have different policy options. So this is the strength of the model. So we have monetary policy, different options for the monetary policy for users to use at their discretion, as well as the fiscal feedback rule. So which assumes the solvency, but it can be changed at the user's will as well. And the main thing is that individual countries are related, are connected through the trade. So model solves for all the countries at the same time. So it uses the linkages through the prices and the competitiveness and the trade at the same time. So all the countries affect each other. We have, as I mentioned, the financial linkages as well. So we look at the integration in terms of the capital market. So we have UIP condition for exchange rates, and the monetary policy change in one country, for example, US, will affect other countries vis-a-vis the exchange rate movement. Next slides, please. So this is our attempt to squish the whole model into the one slide. I apologize if you can't see very clearly what are the equations behind it, but the main takeaway from the slide is that we have supply and demand side of the economy, which are linked. So this is the capacity utilization, which is just under the NIGEM round block. And the green areas that are highlighted, so this is the areas through which we are introducing or introduced the a climate model into the NIGEM. So these are the channels through which we affect the macro variables in the NIGEM model. So what are they? So the first of all is the fiscal block, which will be affected by the change in the carbon taxes. Then the other block, which is affecting supply as well as the demand side of the economy, is the energy. So it affects the so you can assume it as the effects as oil prices. It affects the domestic prices, which are below. And in terms of the energy intensity, so which means that we're covering both, so three of them: coal, oil, and the gas prices, as well as the intensity of the use in each country. It will affect the supply side of the economy, through which, once the supply side of the economy is moving, you will see the effect on the other parts of the macro variables in the economy. So as I said, green areas are the areas that we identified as the channels through which we can implement the climate into the NIGEM model. So next slide, please. Thank you. So climate simulation. So how we went through the process. So the presentations by Katerina and Thomas showed that we identified or tried to identify the channels through which the climate has an impact. So physical effects, we tried to model them separately, and then transition effects are modeled separately. Both of them can be changed, moderated, or exacerbated by the policy choices, which is, as I said, the strength of our model. So in terms of the energy types in NIGEM, so what do we have? We have oil, gas, and coal, and non-fossil, which we have to stress that includes both nuclear and hydro. So we calibrate the demand and supply shocks to match the target GDP values for the GDP effect. So we are supplied by NGFS via Vivid by the shocks. So there's like the damage on the economy through manifesting itself through the GDP effect. So we are calibrating our shocks to give us that impact in the model. For transition shocks, we are using several channels. So we have shocks on the country level to the energy prices. We have shocks on the country level to energy consumption, and carbon taxes, which are applied to all the countries. So these are the same in terms of the magnitude. And then we have the energy intensity coming as a shock as well into the model. Country and regional specific variables on the right hand side, so this is basically what I have said as a shocks, but in terms of the variables, how it will manifesting, that is listed on the right hand side. So we have carbon tax, as I said, energy prices, energy consumption, we have CO2 emissions, energy use, and energy intensity, and the efficiency. So these are the variables that can be shocked in the NIGEM to mimic the transitional effect, impact of the transitional effect in the economy. On the top of that, one have to think about policy choices. So what are the choices that you are making? It's a fiscal choices. As I said, we have the fiscal, so we have the budgetary rule, so which allows you to think about, so what is happening to the taxes, that the carbon taxes that are generated? Does the government use them for the investment? Are they distributed to the households via taxes or the transfers, or the government consumes them? So there are different options, and they will have different impact on the economy, as well as the monetary policy choices. Do we think that the price increase, which most likely will accompany the introduction of the carbon tax, will affect, so is it a temporary effect on the prices, and whether the monetary policy will look through it, or it will react? Or at the same time, if on the other hand side, the impact on the output in the economy is negative, well, the monetary policy will react to that more strongly. So these are the choices that have to be decided by us as well. And the model by default will be running the monetary policy reaction function. So either we can allow it to run itself, or it's our choice to basically say, for example, we are exogenizing monetary policy response. We don't think that the monetary policy will react. So that will have implication on the output as well. And the final one is the behavioral assumption. So even though by default in the model we have the forward-looking expectations, so we say that the markets have a perfect foresight, and all the expectations are then discounted to today's decision. We can think of whether consumers, even though they know that there will be changes coming through in 10, 20 years, do they really can have this foresight, and whether it's better to run the model in the forward-looking mode, or with the adaptive one. So basically you only can change your behavior once things are happening. The next one, please. So to look a bit more in terms of the introduction of the shocks as channels into the model, and what are those that we could use. So how we go about it. So we calibrate the NIGEM shocks to match target value provided by the Vivid Economics, as I said. So we have shocks, say supply shocks. We model the physical effect shocks as the supply shocks. Then NIGEM, we run it through the NIGEM, and we have the output. Then we compare it against the output, and probably we will go through the next round of the calibration and so on before we get to the target level. So for the supply shocks, we use the technical augmenting labor productivity variable, which we have for all the countries in the model. So this is your labor productivity shock. Then so we can use the productivity variable to mimic the changes in the agriculture productivity as well. And we have to think about whether we are modeling the acute or the permanent shock on the physical side. So in which case we can use different instruments. So if, for example, one is impacting more on the labor side or on the labor productivity or agriculture productivity, then we can use one instrument. Or if you are thinking that it's more like a capital erosion, available capital erosion, we can use the other instrument. So, but in any case, these are modeled largely as the supply side of the economy. Next one, please. Thank you. So, to show that a bit in more detail, so the variables that I mentioned, the technological progress and the one that will affect our capital stock directly, these are the TECL on the right-hand side and the IPREM on the left-hand side variable. IPREM is our investment premium, which will affect directly the capital stock, and you will see, so you can cause the permanent damage to the equilibrium capital in the economy. Supply shock, the labor augmenting technological progress as well. This will affect directly the trend capacity of output, and it will affect the labor force and the equilibrium capital in the model. So as I mentioned, both will affect the supply side, although investment premia will affect the investment as well, and your demand will be affected as well directly. So what are the channels? So this is our attempt basically to simplify and to show you how we see the linkages. So for you to have a feeling. So investment premia goes to the capital stock and affects the trend capacity of output, goes to investment and the real GDP. So this is one channel. In terms of the labor augmenting technological progress, it will affect the level of the capital stock, it will affect the trend capacity, it will affect what you have relationship in the labor market as well. So it will affect both supply and demand. So this is one channel. Next slide, please. Thank you. Now, in terms of the impact, so first of all, what I wanted to stress that these are the illustrative examples. So we are showing the examples of the acute shocks, which are applied without end-the-world linkages. So what do I mean by that? So in one case, a country, in this case it's UK, is allowed to run on its own without any linkages to the world. So the shock is applied only to the UK. And this is the orange line. And these are the impact on the GDP, inflation, domestic economy, and the trade. So as you can see in terms of the trade, so the trade linkages are not engaged, so not much impact coming from that channel. If we, on the other hand, allow the same type of the shock to be applied to all the economies, and the world model uses all the linkages that are there by default, then the impact of the same shock on the UK will be completely, not completely, but in terms of the size, the magnitude, it will be almost 3 or 4 times larger. If we look at the right-hand side in terms of the impact from the domestic side of the economy, there is not much change. I mean, the effects are comparable. However, the impact is coming from the trade. So if we look at the chart shows specifically the change into the imported prices. So we see that the imported prices are falling, which will affect the domestic inflation. So this is the pass-through on the left-hand side. And with in terms of the GDP, given that the negative impact coming from the net trade, you have larger and a more negative impact on the UK GDP. So what I'm trying to stress here, that the linkages matter. So if you are on your own, the story is different. If everybody else is affected by the same type of the shock, then trade effects can be quite large, especially if you are small and open economy and the trade is important share of your GDP. And the next one, please. Thank you. So how we model now in terms of the linkages, the transition effects. So we have energy prices coming from the outside of the model, which are imposed. So energy prices are calculated by Vivid, as we mentioned, as Thomas already mentioned, which affects from one point, so it says a dark gray lines energy intensity, and that will have direct impact on the economic capacity. So what are the sub-channels? So you have impact on the world prices and the carbon tax. So these are your price effects, which will affect, if you go down by one level, your profits. Through the profits, it will affect corporate taxes, it will affect budget and the debt level in the economy. Profits itself affect the equity prices, through which, depending what share of the financial wealth you have, in terms of the impact on the households, you will have different impact on the household consumption. The world prices itself directly will affect the imported prices. As I've shown you in the previous chart, the impact from the world switched on and off, and then from the imported prices, you have additional impact on the domestic prices as well. The next one, please. Now, these are several equations, and I will go through them very quickly. These are all in the manual, which Ian distributed with the latest model. But just quickly to illustrate basically the channels, again, once more, through which we are imposing the impact on the economy. So economic capacity in the model is given by the Cobb-Douglas production function. So Y cap is our trend capacity of output. The K is the capital, L is the labor, and the M is the energy input, which is the constant share of input costs, and which is modeled by the so it's like a volume of the energy multiplied by the GDP, and we are affecting our OIVOL variable through the shocks. So how we can affect the OIVOL variable? So if we look down, the epsilon is the change in the price of the energy. So it depends which energy we use. If 3 of them will be affected, so the effect will come through all 3 of them, and the corresponding change in the consumption of that fuel as well. So it's like the energy efficiency variable. The other one, which is the oil intensity, is the variable that comes from the IAMS input. So we can directly shock the intensities, sorry, not oil, the energy intensities, because oil was previously the only input into NIGEM, so I keep saying oil. So energy intensity of the fuel. So it can be gas, coal, and oil, as I mentioned. So summing them up, you will have the impact on the total energy volume in the economy. So if that variable is increasing, then your supply side of the economy will be affected in a negative way. So next, sorry, not next one. So one more thing. So in terms of the price of the fuel, how we model that. So we have the world price of the fuel, and then we add the carbon tax to that, and the share adjusted by the share. Next one now, please. Thank you. So a bit more about the carbon tax in NIGEM. So we introduced the carbon tax rate variable, which is the taxes that are collected. So it's the revenue from the carbon tax. And if we divide it by the nominal GDP, so this is our tax rate variable, where the revenue of the carbon tax itself is given. So the exchange rate, because it comes in a dollar, so we have to change it to the country units. CO2, so how much you are emitting, and the corresponding carbon tax. As I mentioned, it affects the budget. So that was our first chart when we tried to show basically the whole model with its blocks of the linkages. So this one effect is the budgets, which is with the variable that it feeds to it, it's a miscellaneous taxes. And the change in the rate of the carbon tax variable will, as well as the change in the rate through the inflation, will affect your collection of the taxes, and that goes directly to the budget. So this is the part of the budgetary component. So in terms of the corporation taxes, so that's another channel. Corporate tax rate is the existing corporate tax rate which we have in the model, plus the change in the E-tax-R carbon tax rate multiplied by the ratio, and the proportion is the taxes paid by the business. So we adjust by that. So it's not the full taxes are paid by the corporations. Part of it will be paid by the corporations, and part will go to the households. in terms of the impact on the deflation. So with domestic inflation, you have consumer expenditure deflator for all the countries in the model, and that equation has been adjusted to account to the change in the tax rate. So if you, in a simple terms, we can think of it as a VAT type shock. So once you have the increase in the VAT rate, it affects directly your consumer basket and the prices. So that's exactly the route that we took. Okay, the next one, please. And then finally, some of the results. So how we do about the construction of the simulations. So model, an NIGEM model has ability to stack the simulations, i.e. when the output from one of the shocks, once you run it, can be used as an input for another one. So in this case, we can basically run one shock, physical one, and then use it as a base for the transitional shock. And then if the shock, for example, is large, you can even divide into the small shocks, and the final product will include all the shocks, so physical, transitional, and whatever you wanted to add. So it will give you the combined picture from applied shocks, and that's what this that's what this chart tries to show. So we're starting from the climate neutral base, and we apply the physical shock first. Then this is used to become a base for our transition shock. So transition shock is applied, then combined results are illustrated. And on the right hand side, so that's what we mean stack versus transition only. This is for the orderly scenario that we produced. The black line shows the output from the combined shock, which has both physical and the transition, and the orange one is the only transition. So the difference is the physical one. So as we said, the physical in the orderly one has a small impact. So, and that's the difference between the two. Next one, please. Thank you. So the other bit is just to compare the impact for one of the scenarios that we run. As I said, this is all illustrative. Orderly versus disorderly, impact on the UK GDP and the Chinese GDP. So you can see the shock for the disorderly is applied after 2030. So that's why you have orange lines flat on the base before that period. And after that, once the shock is applied, you see the impact on the output in the economies as well. So this is the same across all the economies. And while with the orderly one, you see the impact on the economy materializing or showing itself from day one, it is a more gradual reduction compared to the disorderly one, when you have much larger shock coming in a shorter period of time. And in the end, in most economies, the disorderly effect is larger compared to what you've seen with the orderly one. Next one, please. Okay, so just to highlight the complexity of the model once more, when we impose the shocks, and there are different shocks, they will be affecting economy through the different channels. And we wanted to highlight basically the tensions, so-called tensions, that one will be experiencing when using the full-scale macroeconomic global model. So when you introduce the world energy prices, so when you introduce the carbon tax shock, because you are using, so you are reducing the usage of certain energy, say for example oil, then the price of the oil decreases. So what we are getting, the world energy price is reduced, which is in itself is a positive shock for the GDP, a positive impact. Energy reduction is, so you have energy intensity reduction, so you need less of the energy produced to produce the same level of the output. This is again the positive shock for the economy. Carbon tax revenue, either through the government investment or if it is spent on the consumers, so it's again a positive. And the monetary policy, if it is accommodative, of course, will have all the positive impact on the GDP. At the same time, you have other channels, i.e. the carbon taxes, reduction in the profits, negative wealth effects because of the falling equity prices, and the low productivity because of the erosion of the capital and the physical effects in general. So you are seeing basically two channels working against each other, and that's what is model basically delivers. So there is not one answer that if I put several shocks, so what is the impact on the directly on the GDP? So that's not what we are exactly trying to answer. So our aim is to show the linkages, the channels, and the thought process behind the implementation of those shocks. If you look at the inflation, the story is similar in terms of carbon taxes are expected to increase the prices, and the change in competitiveness, it can have the negative effect as well as positive effect on the inflation. World energy price reduction will reduce the inflation, energy intensity reduction as well, and the monetary policy can go both ways. If it is accommodative, it can support prices. If it is trying to fight the prices, of course, then it will decrease it. So these are all the bits that basically model as by default. And I think that's the last slide. Okay, so there are several examples, simple examples to show once more the effects from the different channels. So what we mean by NGFS, these are the shocks that have been supplied by NGFS and then via Vivid disaggregation. So if we take all the shocks, so this is the impact on the economy. However, what you can do, as I said, you can have prices fixed on the base, in which case you will be having the larger negative impact on the economy, i.e. world energy prices are not allowed to fall as much as given by the NGFS scenario, which means that you lose that supportive mechanism for falling world energy prices, and that's why your GDP is affected more. Trade effects. So this is black is again NGFS running all the countries, and the shock on the UK only. The trade effect initially is slightly smaller, but in both cases you have quite comparable negative impacts. Next one, please. Thank you. So this is our attempt to show that what do you do with the carbon tax revenue is important. So the decision that you are making for the simulation purposes, definitely. In the NGFS default scenario is shown on the chart. We are not assuming that government takes the revenue and invests or consumes it in any way. So by default, tax rate will adjust to basically accommodate for the increased revenue in the budget, which means that the taxes will be distributed automatically to the household. So this is the default function in the model. However, if we are taking this revenue and adding as additional shock for the government investment, then the impact on the GDP is less severe. So basically the impact is higher. Now, another channel of the feedback mechanism, again, central bank response. So in one case, the central bank responds. In another one, you fix the interest rate. So i.e. monetary policy is looking through the changes in the prices and the economy, in which case you do not have accommodative monetary policy anymore. And that's why in the initial stage, you have the larger drop in the GDP compared to the other case when the monetary policy is allowed to be accommodated. I think that's the last one. Thank you very much. And I think we can open the floor for the questions now.